Lee, thanks for joining. Really appreciate it. Lee, can you please tell us about your background, your expertise, and your career highlights? Lee?
Yeah, thanks, Raz. Thanks, Raz, for the introduction and for the opportunity. So I've been in the game 38 odd years, and been running predominantly funds management for pretty much the bulk of that time. Armytage is now celebrates its 28th year next March, so it makes us the oldest independent boutique running monies in Australia, which is something we're pretty proud of. I suppose career highlights. There's been a lot of successful public companies. I founded a company back in the early 90s called Treasury Group, which went on to become Pact Group. We started that with a market cap of about a couple of $100,000, and it's now sitting well over 380 to 400 mil. And in its heyday, it had about 16.5, $17 billion of funds under management. So that was a great success. There's been several others along the way, but primarily it's been the growth and the opportunity that Armytage has provided, which has provided the best source of satisfaction.
Fantastic. Lee, can you talk us through your funds that are available for investors and how they have performed in the past 12 months? Given the current market condition with the interest rates have gone up from 0.10% to 2.85%.
Yeah, not interesting question, Raz. I suppose over the journey of the 39 odd years that I've been in the industry, the lesson that you take away is expect the unexpected. And what we had happen in what hit capital markets in February 2020 and into March with the COVID had never happened in the history of capital markets ever. There was no rule book, there was no precedence. It was really just flying by the seat of your pants. And what central banks and governments had to do worldwide there was totally unprecedented. And we're at the back end of that unwind now. And I'm leading into answering what the funds have done and the funds that we run. So with that as a backdrop, it makes the GFC and everything else pale in insignificance. So the takeaway with our funds is we try to control the controllable. And given those issues that I've just raised, it's just impossible to second guess and to plan when you got situations like that. Heaven forbid, we had a war in February 2020, which is still unwinding, and the impacts of that are felt worldwide. Can you believe it? It's just extraordinary. So once again, expect the unexpected. So the two prime retail funds that we run, one's called the Australian Equity Income Fund. Its universe is the top 100. It pays quarterly distributions and is just for that reason. It is very conservative by nature. It avoids noise, it avoids bubbles, and it focuses on one thing, and that's cash, and cash into unit holders' pockets. And from a planner's perspective, it's very important so that you can try to plan what level of cash is coming into clients' portfolios and in order to supplement their lifestyle. We run a covered call enhanced income policy there. So all we simply do is just sell covered calls over existing holdings, and that's just to generate additional income. And that policy generates us somewhere between 2.5% to 3% of additional income per annum, on top of the rolling yield of somewhere between 4.5% to 6%. And that's where we get our 7.25% to 7.5% net income return for clients. And on top of that is your franking. Very difficult to work out what the franking benefit is for investors because we don't know who the end retail investor is and what their tax position is. But smart advisors like your good self, Raz, do. So that's an important part. The fund is utilised a lot by planners who are looking to accumulate, and they take advantage of the DRP policy, and the multiplier on the compound of the distributions on a quarterly basis is quite significant. And so if you take a view that an investor might say sit there for 5-7 years, and if they were to DRP, and if you were to compound that every quarter, it's quite substantial. And so you might start with 100,000 units today, and in 5 to 7 years' time, you could end up with 175 to 200,000 units, still paying you the same distribution, but the cash that's now coming into the client's portfolio or in bank account to supplement their lifestyle is quite significant. And so a lot of planners do use that. The other fund is the Strategic Opportunities Fund, and its universe is the top 500. So about 20% of the portfolio is invested in stocks outside of the top 100. And that's where we try to generate a little bit more alpha. Things like Collins Foods, Webjet, who else would there be of recent times? We're looking at some of the lithium stocks. Mincorp, for example, has now come into that space. So the higher alpha bets or investments are taken in that fund. It pays distributions every half year, and like the income fund, it also runs an enhanced income generating policy where we just sell covered calls over existing holdings, and it's tracking at slightly higher yield because the smaller stocks that we hold in there, things like Jumbo, Collins Foods, as I said, pay a slightly higher dividend, so that gives us a slightly higher yield. So it's tracking at somewhere between 7.5 to 7.8% net for the investor, but it pays half yearly. So the planner can choose what risk profile they wish and to what degree they want to have the accumulation occurring versus the income coming in. The other fund that we run, which isn't open to retail investor, is the Armytage Activist Microcap Fund. It's a wholesale fund. It's very concentrated. It only has 7 investments in it at any one point in time, and it is to generate very, very high alpha. It started in September 2019. Its focus was is to identify takeover situations in 3 particular sectors. One was diversified financial services. The second is SaaS, and the third is food. We kicked it off in September 2019, and we've been on receiving end and also participated in and or helped drive 11 takeovers. The unit price has more than doubled. It's about $2.18, $2.20 as at today's date from a starting point of $1. So it's been a really good investment. And there's probably a lot further to go in that space. So as I said, it focuses on micro caps, which is sub 50, 60 million. And there's not a lot of competition down in that space. The big banks and the PE firms don't spend a lot of time down there. It's purely simply because of size, not so much, question of return. But it's very rewarding for unit holders and a source of a lot of satisfaction for us here at Armytage.
Congrats, Lee. That's some tremendous growth in that small cap fund in a very short amount of time.
Yeah.
So I'm wondering, you sort of touched on we are in sort of unprecedented times these last couple of years. So what are 1 or 2 investment principles that you've sort of been able to depend on over the years, to continue to grow the success of Armytage?
You've got to avoid the noise. Which is very hard, and I'll give you 2 examples. The buy now pay never phenomenon. When I was a boy growing up, was called lay-by, and was used by people who weren't able to purchase a product, their Levi jeans at that point in time, and so they paid off those Levi jeans over installments over a period of time, and once they paid it off, the store gave you your Levi jeans and you walked out. You felt really terrific. What's now happened is the store gives you your Levi jeans and then you pay a massive premium. The merchant takes on the risk and then they hope that the person pays for their Levi jeans. It's an extraordinary change of philosophy as to how you do business. But that sector grew a life of its own, and there were stocks that were coming to market on 100, 200, 300 times multiple of revenue. Just total fanciful nonsense. But what happens is these stories and these bubbles and these momentums, they're tracked by indexes. They cause performance to either go up or down. And if you aren't invested in tracking these bubbles and stories, you're underperforming relative to this noise and fictitious nonsense. And so what then happens is a client goes to the golf club or to the yacht club, and he starts showing off about how brilliant his investment is, you know, how fantastic he's done with this, that, and the rest of it. Sadly, you never hear about when the story goes the other way or they lose money. You only hear about when they're allegedly making money and being on this roller coaster road. From a fund manager's perspective, it's so easy to get caught up into that bubble, and it's very tempting to think, gee, I have to have an exposure to this because I'm lagging. And the hardest discipline is to say no to nonsense and take the abuse from your client. And more often than not, they take their monies out and they go into hot funds, but you don't have the decency to ring them up and ask them afterwards, how did you go? So diplomacy has us not do that. But you only have to look at where a lot of these have gone, and 2/3 of the ones that have listed have gone broke, disappeared into the sunset. A couple have survived. Buy now, pay later has sort of struggled along because it's now been lost inside a square. But as a business, we're hearing horrendous things if it was still listed and trading on its own. So avoiding noise and the bubbles is very, very crucial. The other massive bubble that's happened in our lifetime is this crypto stuff. Well, fortunately, we aren't able to invest in them because they are not an investment grade security, or whatever you want to call it, investment under our license. And because they're not recognised by the RBA as a form of tender, we can't invest in them. But once again, the fortunes that have been lost playing that game, and all the smutty pantsers during that period of time that thought that they were gurus, are now stone motherless broke. And you now see the unwind of that whole lie that was it with this FTX, and how many fortunes have been dusted up because of it. A lot of fund managers we became aware were playing crypto in their funds. And what they were doing, they were buying ETF securities that had crypto as an asset base. And these investments were inside a fund like, heaven forbid, an ALF, or something like our income fund, or something like our strategic opportunities fund, but would be only one or two investments that are in it. So it was sort of lost in the portfolio. But when these things blew up, they blew up very, very hard and have gone to zero. Of course, you don't hear about that. You don't hear about your client that was giving you a hard time about, you're underperforming, you're not doing this, you're not doing that. Where are they today? And so the lesson is to avoid the noise and to be man enough to say no.
That's fantastic
It's
advice.
bloody hard to do, believe you me.
Hard to do, I imagine. So what do you see then being the major risk that might play out into the global and Australian markets over the next 12 months?
Yeah, good one. Look, we think that we're past. We think that we're past our the nadir. We said in April, May of this year, Raz, that we try to break it down into blocks of 3 to 6 months. And because of the just massive volatility that we've endured since COVID, to try to plan anything further out than that, good luck. You can say what you wish. If you can get it right in these blocks of a 3-month block and then another 3-month block, it just gives you confidence, and it gives you greater liquidity to move if you need to. And we said in April, May, that we felt interest rate genie and the inflation genie was potentially going to be back in the bottle around from the, say, October through to the Christmas period. And, you know, let's hold us strictly on the dates, but give or take a week or two either side of those general months. And heaven forbid, it seems to be the case. So we back the Fed, both here and offshore, that they got it right, only because what they were dealing with was completely and totally unprecedented. And all the Johnny-come-latelys that were criticising the central banks and governments in what they were trying to do with circumstances that were completely unheard of was just stupid folly, because it was just too difficult. And everybody's a genius in hindsight. But when you've got the hands on the wheels and you've got to make the decision today, it's a different game. And so we felt that the unwinding of what happened to save world markets and effectively the civilized banking system as we know it today was always going to take hicks and hups and hicks and whatever you want to call it, until we now are drifting back to normal times, which we are now doing. Now, if it's another 2 or 3 months this way or another 2, who cares? The trends are that we are now drifting back to normal times. Inflation does look as if it's now getting under control in the States and worldwide, and interest rates and how the banks put rates up in order to try to control demand and the price of money, giving it some value again, I think they're going to get it right. And we suspect, our view as we're sitting here running into the Christmas period is, yes, there is going to be some further, you know, maybe another rate rise or 2, possibly even 3, but tell me something we don't know. So these things are now priced in the markets, and markets move in expectation, not realisation. I'll say that again. Markets move in expectation, not in realisation. So if we know that there's going to be at least another 1, maybe 2 interest rate rises, that's factored in. And the economy lags anywhere to 2 to 3 months behind these economic decisions. So as we are likely to see a potential increase to unemployment, property prices coming down, the prices of consumer staples going up, well, we all know this. It's now working its way through the economy, and within bands, I think they've pretty well got it right. Our view from, say, March 23 through to about June 23 is talk will commence about interest rate cuts. You heard me. Talk will commence about interest rate cuts. And you may start to see some interest rate cuts at the commencement of the second half of 23. But the talk will start before then. So the market will start to build that into the pricing of equities and in the pricing of other assets, cash, property, so on and so forth. So we're suggesting that we could be in for a nice re-rating of the markets between now and Christmas, potentially a plateau period next year until we get some equilibrium. And then if the market senses that interest rates are going to be cut because they want to start to stimulate the economy, you know, that could and well and truly lead into another re-rating of the markets in the back half. But this is how long it's taken. And let's say it's September 19, it's September 23. This is how long it's taken for us to return to some sense of normality after what we had to endure in February and March of 2020, when effectively the world was all over as far as financial markets were concerned.
In that case, Lee, are you expecting a significant shift or trends in the upcoming years with the financial market, given you believe the rates are going to come down, say from middle of next year?
Yep. Yeah. So we anticipate equity markets improving, and it will be your traditional staple stocks will go first. Boring things like Wesfarmers, Woolworths, Coles, Endeavour, the banks. Your traditional businesses and entities that have got replicable earning streams, because they're the ones that are going to react first as the price of money comes down and consumer confidence lifts. I mean, consumer confidence is still as strong as it's ever has been, which is quite remarkable. Now that may start to taper off next year. Like, we were big backers and supporters of the tourism industry, and we've got it right with Webjet, and Flight Centre still hasn't, and don't laugh, Flight Centre still hasn't taken off yet. Thought I'd throw that in for you, Raz, but it's likely to. And you go to an airport today and it's pandemonium. It's worse than a zoo, out of control. And so that will start to filter through into the earnings of Flight Centre and corporate travel. So, and Qantas has been re-rated. Webjet has. It's really taken off and will continue to do so. So we see a similar trend, and that was probably an easy one, an obvious one. Travel was always going to be one of the first ones or sectors to recover from the catastrophe of the COVID thing we had. What are the other ones? We suspect that it'll be your traditional low risk industrial businesses, and they will start to outperform.
With the war going on in Ukraine, how does that kind of impact the financial markets? And I know the Europe is actually pinching. They have a massive energy crisis issues. So how's that going to play into the market?
Well, one of the things that Vlad totally misunderstood was that one of the things that is certain going forward is that Europe, within 18 months, 2 years, will be, I won't say self-sufficient of energy, but Russia will be just a top-up. Will be just a top-up agent. They're already starting to build pipelines from the North Sea, from Norway as well, and they're already now starting to significantly increase the tanker supply of gas from the US, and Australia won't be far behind. So the once upon a time monopoly that Vlad had is going to win. Now we're going through the changeover phase, which is uncomfortable and difficult, but it's something you and I know, so it's not unexpected anymore. And Europe will move to a freer market and a totally unreliant market on one supplier. This will never ever happen again to Europe, ever again. America will never ever again be beholden on Chinese manufacturing. They learned that after COVID. That'll never ever happen again. You will never see containers into the horizon sitting on Chinese ports with the Apple badge stamped on it, not being able to be moved. That'll never ever happen again. They will move and broaden their manufacturing base. It'll be done without noise, but it will happen. And Xi has got a serious issue on his hand, because corporate Australia, corporate America, and corporate Europe is moving, and will never become beholden to those two powers ever again. Well, not that Russia's a power. How it impacted here in Australia is it put up the price of wheat, which put up the price of feed, which impacted into a lot of manufacturing industries here in Australia, poultry division, the dairy division, Food manufacturing is also impacted because of it, because wheat is a world commodity like milk is. It's priced on a world commodity basis, so it impacts here. So as those prices went through the roof, it impacted on what we had to pay here. Now that those prices are coming off, it's making it a lot better and a lot cheaper for Australian manufacture to now return back to normal. But what will happen is this will never ever happen again. Australia will be more and more self-reliant on its own grain production. I mean, given it's one of the world's biggest producers and exporters, will it export to the same degree next time? We'll see. Maybe there's a little bit more that'll be stored away in silos for a while. But these shocks tend to affect the person that causes the issue. It hurts us because we're receiving it now and having to live through it, but it doesn't happen again. And that's where I think our economies will be a lot more stronger going forward because of it. But we see world growth returning next year, the back half at least. The interest rate, as I said, the interest rate genie and the inflation genie is now, looks as if it's back in the bottle in the States. That means it'll be back in the bottle in Europe. World travel is now absolutely going gangbusters. So the world is now opening up, and we suspect that, you know, the back half of next year, all the catastrophes that we had to deal with have been dealt with. They're priced in the market, and now we're moving on. Now, your next question is going to be, so I'll get in before you ask it. What can you anticipate coming forward? And the answer there is, I've got no bloody idea, because who knows? And anybody that says they've got an idea as to what catastrophe can come next, you let me know, because it's just too impossible. And it's even beyond the realms of sometimes imagination to think what the next one could be, like a war in our own home in this era. Unbelievable. You know, a world pandemic of health. Unbelievable. Zero cash rates for more than 2 years. Unbelievable. So there's just three. So to try to think what's the next one going to be, you know, who knows? There'll be something out there, and, you know, markets will manage them. And I think that's one of the things that investors can draw comfort from the last 2.5, 3 years. While it's been horrible, you know, we've stumbled and fumbled our way through, and there hasn't been a lot of catastrophe. Like we were talking about this the other day. We were trying to think of one reasonable size Australian public company that's, say, top 100, 200, even 300, that has gone broke because of it. We couldn't think of one, could we, Austin? I didn't mean, yeah. And so that's a testament also to the, you know, to the resilience of economies. I mean, even in the States, there's been a lot of rubbish that's gone broke and disappeared, but they were storytelling liars. So you expect them to go there, but your more traditional businesses, they seem to have, you know, taken it in their stride. Yes, taken the hits, but have improved and gone forward. So yeah, that's the outlook going forward.
So on the back of that, is there anything that you've perhaps been, you know, underweight in terms of the sector recently that you think, you know, maybe you want to pay a bit more attention to going forward? Yep.
The sector that we've under invested in for a while has been the EV. I'll just call it the EV renewable division, class, sector, whatever you want to band it, and then the mining companies that sit behind it. Because here in Australia, we don't have the technology that facilitates in that space. We just dig a hole in the ground and supply the raw material that goes into the end product. And we've been slow there. 2 reasons. One, we don't invest in businesses that, particularly in the 2 funds, they need to be income generators, because the mandates of the funds are that they need to have an operating business with replicable earnings and replicable dividend stream. That's the mandate that we have to deliver on clients. And so if client you know, if an investor wants to have that higher end, higher offer exposure, then don't come to our fund. It's not our job. Our job's to deliver replicable earnings and at the higher end. Now that you are seeing a lot of the stocks that are in this space, things like Alcam, Oz Minerals just recently been taken over by BHP, MinCorp, IGO, there was another one, Pilbara. These companies now are moving into production phase. They're now starting to look and operate like mining companies that have got a depth, they've got long mine life proven. So they're now starting to look like, dare I say it, mini BHPs or mini Rios. And so you can better assess the risk and you can better assess their forward outlook. And given that this sector isn't going away, I think everybody on this phone, if you're not already driving one now, will either be driving a hybrid car or an EV car within 1, 2, 3 years. It's just a fact of life. An investor said to me once how quickly the speed of mobile phone take-up was. And he indicated to me that expect the same take-up with the EV vehicles. It'll happen very, very quickly. Now, people just saying, oh, there isn't the charge station. Our view is you create the demand, by goodness, the supply follows. It follows very, very quickly. And this is back to the mobile phone phenomenon and how integral they are. You know, the thing this big, the size of your hand is, you know, it has the same power capacity as a computer that used to have 10 data banks. So this is a fact. And we've now streamlined it down to 4 companies, and we've been accumulating in those, and they will now form part of the equity investment strategy going forward in those 2 funds, being the Income Fund and the Strategic Opportunities Fund.
Great, thanks for that insight. One last question from me. I just want to understand how much value you place, I guess, on management and their abilities, and how you actually go about determining their credibility.
Yep. In the Microcap Activist Fund, that's the fund one, 80% of our research, and don't fall off your chair when I tell you this, 80% of our research is qualitative. 80%. And that is completely understanding management, the relationship that exists between management and the board, and then how the board operates in its own right. And there are 3 relationships there, Raz. 3. And you've got people at each one of those 3 points. That means you've got 3 sets of circumstances, and we all know what people are like. They can change their mind very, very quickly. But a lot of time is spent seeking to ascertain those dynamics. When it comes to bigger cap companies, things like Endeavour or the banks, management tends to not be the central driver of the fortunes or the outlook of that business. Take the banking sector, for example, which we are in a solid overweight position and will continue to remain in an overweight position while interest rates are where they are, and also the earning capacity that they are generating for unit holders is absolutely terrific. The managing director of, say, an ANZ or a NAB, it doesn't have the same impact across the operations of that entity as, say, something that's got a market cap of 50 to 100 million. There are a lot of layers within the big cap stocks. There's a lot of philosophy and a lot of ingrained management beliefs and outcomes that have to be achieved by boards and different layers of management. So you tend to, with the big cap stocks, let's say the top 100, it's more on the management philosophy of the entities rather than 1 or 2 individuals that may be the mouthpiece for it. And sometimes the mouthpieces don't speak and present well, and so they're not given the rock star, movie star status. as say another auditor does. However, the company is still achieving and doing and still achieving its same outcome. But because the auditor isn't as glamorous as another one, it tends to not get the same outlook. Like Matt Common, you know, is he more a better auditor than McEwen at the NAB? Hard to say. And yet CBA is trading on a multiple of 18 PE versus NAB on 13 or 14. Now, you can't tell me that CBA is a 4 or 5 times better bank than NAB. It may well be, but and that just boils down to image and presentation style. And you know, NAB's had to come from a long way back because of the issues that it's had through the Hayne Royal Commission, along with ANZ and Westpac. And funnily enough, it was CBA that was on the receiving end of the largest payment for settlement for remediation payments versus the other three. But they managed to speak better in the marketplace. And, you know, they were just a lot slicker and better at it. So big end companies, it's the assessment of the management is broader and deeper. Smaller cap companies, you tend to focus on the one, maybe two.
Yeah. Okay.
Thanks,
great.
Lee. We like asking all our guests this question. What this question is, what is one thing that excites you about the future? And what's one thing that frightens you about the future? It can be related to financial markets.
Well, the thing that's exciting about what we do for a living is that every day is different. And some people might say, well, that's frightening because you know what's going to come next. But that's the exciting thing about it. There's not one day, no 2 days are the same. They might look the same, but they're not. And that's what's exciting and dynamic about it. The thing that concerns you, you know, you could the dictator in China do something crazy? Look, I doubt it. I think that he's had a look at what that clown in Russia's gone and done and thinking, gee, how smart was that? You've totally bankrupted your economy. The world hates you. And what have you achieved? And China, it's trying to be the global manufacturing base. Well, it's losing its manufacturing base as we speak. Day by day, plants are moving. There's less capital being spent by the Western world on plants and businesses based in China now. So it's starting to feel it. And does he really want to be on the end of you know, sanctions to the extent that it's just crippled and destroyed Russia? I don't think so. I just don't think that he's going to be as stupid. But it is there, you know, he's been wanting to, you know, be a hero with his guns and prove to the world that his military can shoot and die. But, you know, the track record ain't great from his friends. So that's an outlier that could come. Outside of that, you know, another pandemic, could that come? You know, a weather event, could we continue seeing, you know, the climate change and impact that it's having? I think that's a possibility. But outside of that, it's you know, you're guessing. It's always where you least expect it.
Definitely. Thanks for your time, Lee. Really appreciate it. And it was a very good conversation. Thank you.
Thanks, Raz. And all the best to you and your happy client base.
Thank you.
Thank you. Thanks.